Catalina here from LoanSense. Today is the last day of January. I cannot believe this. Today we're going to talk about some news in the student loan world. I also want to talk about a scenario and a case study from a borrower that came through our service this past week, actually a few days ago. And then lastly, I'm going to end with some updates by the government-sponsored agencies, Freddie and Fannie, on alternative credit, which impacts a lot of student loan borrowers who are trying to get approved for a mortgage. So that's what today's video is going to be about. I'm combining content that loan officers and borrowers themselves would like to hear, because when I do sessions and consumers are like, this is meant for the loan officer, but I learned so much. I thought I would combine this video because it's information that's useful for both parties. So first and foremost, we're still pending the February 28th Supreme Court hearing. There's all kinds of news articles on the prediction of what's going to happen. The Biden administration is extremely worried about the numbers of defaults and delinquencies that are going to be experienced as a result of a strike down, if the Supreme Court ends up striking down loan forgiveness. Because 18 million Americans are supposed to, would have received complete forgiveness, and that's also the population owing under 10,000 is the population that also tends to default on their student loans. So the Biden administration's scrambling, thinking about what to do. Of course, they're rolling out a new income-driven program that is supposed to offer relief as an alternative if loan forgiveness does not happen. So I do want to bring that up. I do talk last week pretty extensively, actually was it 2 weeks ago, pretty extensively on this new plan. The commenting period is still open. So if you do not see my video on commenting, I will link it above here so that you can comment in support of the program that will lower the payment for low to moderate income Americans. Okay. So that's the news. I do want to talk about a case study from a borrower. There are a lot of borrowers that already receive $0 payments on their student loans. If you're a borrower that has received years, and maybe not years, but even recently $0 payments on your student loans, and you try to go buy a house, well, lenders cannot count that $0 payment. So they're going to use a much higher 1% or even 0.5%, which if you're getting a $0 payment, you're likely a low to moderate income borrower. I mean, earning under 75,000. That's how you get the $0 payment. And every penny counts that you owe on your student loan. So if you have 100,000 of debt and the lender uses $1,000 and you're earning 75,000, you can afford very little home, right? So this consumer came through and is like, I have a $0 payment. My lender's saying I can't buy. What are my options? And of course, at LoanSense, we help people close, but we also help people understand their options to affording, to actually better financial wellness with loan forgiveness, right? We do both those things for borrowers. So it turns out this borrower also had Parent Plus loans to consider, as well as her own loans to consider. So she required a few different plans, and she realized she couldn't just call her servicer and request to pay $25. You can't just call them up and say, hey, can you make my plan $25 instead of $0? That's not how it works. And you also can't just call them up and be like, hey, I want to be put into these plans instead of these plans. These are all paperwork processes, and we're here to help people who, especially if you have $0 payments and it's going to impede or make it more difficult to qualify, whether it's for a conventional or FHA loan, we're here to help. So essentially for this borrower, we're going to have to refile the paperwork, even though normally she was very on top of it, refile this paperwork, as well as help her understand what plan she should get into, considering she has both Parent Plus loans and her own loans. So it's two different plans. And it's not just one plan, right? Parent Plus loans only qualify for what's called income contingency repayment, whereas the other loans qualify for income-based, revised pay-as-you-earn, and pay-as-you-earn. And by the way, this is why revamping the student loan programs is so vital, because fewer options, fewer noise makes it easier for you all, right? So that's why I invite you to support commenting in the Federal Register for this new plan, which will consolidate all plans under revised pay-as-you-earn. Wanted to state that. I do think it's going to exclude Parent Plus loans, though, from what I read. And now let me roll over to my weekly news update on this new Freddie and Fannie guidelines that are rolling out. Freddie and Fannie, as of May 1st of this year, will allow borrowers with not much credit history or not as many trade lines on their credit to use what is called alternative credit or add trade lines to the scoring or in the formula to include things like your T-Mobile bill, your gym membership, things that you're already paying that are more like service agreements, so it doesn't end up on your credit. Like they'll even credit your rent, right? So that you have a positive payment credit history and help kind of build a person's credit. Lenders will now allow this because it's part of Freddie and Fannie's guideline to help build consumers' alternative credit. I wanted to put that out there because that's really, really valuable. So if you have fewer than 3 trade lines on your credit report, like you've only had a student loan ever and a debit card, but you've never had a credit card, well, you only have 1 trade item or you trade item. So maybe you have a credit card and a student loan payment, but you only have 2. You need 3, right, to create that solid balance of credit and payment history in order to grow your credit, but also in order for lenders to consider the risk of lending to you. Well, now this new alternative credit source will allow lenders to count alternative items that are not currently on your credit report. Again, if you've been very insistent on going to the gym and paying for that membership, that can now help build your credit, right? You pay for T-Mobile, even Netflix, like things that you already are paying and paying on time can help build your credit for mortgage lending purposes. And of course, the guideline is 12 months of history paying that. So if you just started paying for the gym, then that's not 12 months of history, 12 plus months of history to build that credit line. So I wanted to come out with that news because that, of course, impacts our customers, future customers, current customers, as well as mortgage loan officers who can now make lending more accessible to a market who may have just lower credit history, a lower amount of trade lines and less history with credit. So wanted to put that out there. High debt to income is the number one, is a higher reason for decline than credit, but credit is still a huge consideration, right? If your debt to income is too high, they can't lend to you even if you have perfect credit. If you have lower debt to income, we can help you lower it, but you have no credit, that also makes it an issue, right? So advice for anyone saving, for those that want to buy, save up for a down payment, work on building your credit or your credit trade line items that can be counted and constructed in an alternative credit. But mostly having on-time payments, really, really important, saving for that down payment and making sure to sort out the debt issues you may have, understanding that a federal program may help you right-size your student loans, lower your DTI, and also help you, once we get kicked into repayment, manage other forms of debt. I hope you found this helpful, this video helpful, this news and information helpful, especially if you are shopping, getting ready to buy a home. So if you found this information to be helpful, please share this video, please subscribe, and if you like it, please like it. I hope you have a fabulous day.